Physical Gold Fund presents Global Perspectives with Alex Stanczyk and invited guests. We'll be exploring international markets and the complex forces that drive them, including geopolitics, economics, and the global monetary system. Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to the latest podcast with Alex Stanczyk in the series we're calling Global Perspectives. Alex Stanczyk is the Managing Director of Physical Gold Fund. Alex is an expert in the physical gold industry, dealing with the logistics chain from refinery to secure transport and vaulting. And he's lectured globally to investor, institutional and government audiences on the role of gold both in the international monetary system and in investment portfolios. Our guest today is Ronald Peter Stoeferle. Ronald is Managing Partner and Fund Manager at Incrementum AG. His company focuses on asset management and wealth management and is based in the Principality of Liechtenstein. Before becoming a partner at Incrementum, Ronald Peter Stoeferle worked in the research department of Vienna-based Erste Group, where he started writing about gold in 2006. In 2015, he published his first book, Austrian School for Investors: Investing Between Inflation and Deflation. Ronald is the author of the annual report In Gold We Trust, which was named as the gold standard of gold research by the Wall Street Journal. The 10th edition of In Gold We Trust was released in 2016 and gained immediate worldwide recognition, with newspaper coverage in more than 60 countries. Jim Rickards has described In Gold We Trust as the most eagerly awaited and closely read report in the gold community. So, of course, we're especially excited to be talking with Ronald Peter Stoeferle today. Now, Alex, over to you.
Ronnie Stoeferle, welcome to the call. I'm very excited to have you on. I really appreciate you coming on and spending some time with us. I've been looking forward to having you in a conversation like this for some time now. We first met about 6 years ago at a gold conference in London. Since then, your report, the In Gold We Trust report, has become commonly known as perhaps the most closely read annual report in our entire industry. So congratulations on that great success, Ronnie. I'm a big fan.
Thank you very much, Alex. Thanks for having me. It's true, we know each other for ages, it seems, but I think we met the first time personally at the conference in London when gold was really close to its all-time high at 1900. It was back in the good old days.
The good old days, yep.
We'll get back to that.
I'm sure we will. It's interesting. At the top, everybody's always quite happy, right? And that should have been a good indication. But who knew?
Yeah.
Who knew? Okay, so why don't I'd like to start out with a quote. And this quote comes from your In Gold We Trust report, and it's from Russell Napier. And the quote is, "The time is coming when global financial markets stop focusing on how much more medicine they will get and instead start focusing on the fact that it doesn't work." So, generating growth and inflation has sort of been the central banker's goal worldwide for some time now. And, in light of the observation that this does not seem to be working too well, talk to me about your thoughts on this.
In Japan, we're already having the 12th round of quantitative easing. They call it QQE, so quantitative and qualitative easing. So they're also buying stocks, ETFs, and REITs now. But for some reason, people are not really questioning if it actually makes sense, because if it would work, then why do you need 12 rounds of it? So I think we're in some sort of an end game where the central bankers are basically the only ones who try to hold everything together, but we all know that at the end they're gonna make it worse, because I think you're also a keen reader of history, of monetary history. Austrian School of Economics, and we all know that we're in a big spiral of interventionism. And just the fact that the markets these days are only discussing what will Janet Yellen say next, what will this regional Fed director say next, how do we value this piece of information. It's crazy. The market only cares about central banks anymore, and this clearly shows you that this is not a healthy market anymore.
Sure, that makes a great deal of sense. What it reminds me of is the South Seas bubble. If you I know you read history, as you know I do, and if you read sort of the commentary and the thoughts and the processes of what was going on at the time, it's so similar to these types of really kind of crazy bubbles that we've seen in history, like the tulip madness bubble and the South Seas, etc. It's almost like people have become completely disconnected from reality and so engaged in this process. Where do you think that ends, or how do you think that ends up?
Well, we should not forget that during history we found out, or we should have found out and remembered, that central economic planning just doesn't work. So why should central planning of monetary policy be any different? Karl Bass said, if command economies worked, we would all be speaking Russian. And so for some reason, people still trust central bankers because they are impressed by their CVs and their PhDs and their academic work that nobody really understands. But I think the manipulation of the most important price in the economy, the interest rate, is really the root cause for all the problems that we're having, not only in the economy and in finance, but also in our society.
Yes, I agree with that wholeheartedly. I think that's right on. Okay, so let's turn our attention for a minute to these interest rates. Let's talk a little bit about that. I'm going to go with another quote here. This one is coming again from your report. It's from Vitas Vasiliasoukas. He's a member. It's hard to say. Vasiliasoukas. He's a member of the ECB's governing council. And when I read this quote, it kind of floored me because of the hubris is just amazing here. He said, "Markets say the ECB is done. Their box is empty, but we're magic people. Each time we take something and give it to the markets, like a rabbit out of the hat." So this was really amazing to me when I read it. I almost couldn't believe it. Central banks have gone from low interest rate policy to zero interest rate policy, and in some cases, negative interest rate policy in some countries. So what are your thoughts on this? How does this impact the markets? How does it impact society? And how does it impact things like gold?
Well, first of all, for gold, of course, it's a positive environment. The longer we stay that low, the more fragile the whole market will continue to become. We're writing a book. It's called the Nullzinsfalle in German, which is basically the zero interest rate trap, and it means the longer we stay in this crazy interest rate environment, the worse it will get, because then you're so much more sensitive on even a tiny increase in rates that basically there's no way out. And so moment, what did they say last year? They said there's going to be 4 rate hikes in 2016. How many did we see? Just 1. But everybody was talking about all the time. Now this year again, they pretend that there will be 4 rate hikes. I actually don't think there's going to be 4 rate hikes. There will probably be one, but sooner or later we all know that an environment of rising inflation, rising rates, and very high valuations, not only on stock markets but also on bond markets, this is always the perfect recipe for a major correction or a crash in markets. So of course for gold that's a positive environment, because negative interest rates they reduce the opportunity cost of holding gold. It's a great environment. We should not forget that rates were rising, but actually inflation was rising much faster. So real rates became more negative, and this is also the reason why gold is doing pretty well at the moment. So I think coming back to this whole interventionism in rates markets, there's quite a lot of fatal long-term consequences of this zero or negative interest rate policy. There's for securities, for example, this poses major problems for all institutional players, for retired people, of course. We all know that. Consequences for debtors, of course. Standard & Poor's has calculated that budget deficits in the euro area would on average be 1 or 2% of GDP higher if the average level of interest rates prevailing back in the days would be applicable today. So nobody could afford higher interest rates anymore. There's consequences for retirement insurance plans. There's consequences for society itself. You're probably familiar with the so-called Cantillon effect. And in our letter to investors, we wrote that the monetary inflation that we're seeing is working like basically a tax. There's people profiting from monetary inflation, and there's people suffering from from monetary inflation. Because based on the Austrian school, there's first is monetary inflation, then there's asset price inflation, stock markets, art, real estate especially, and then there's actually price inflation. This is what central bankers want to see. And there's a huge distribution going on, and I think it's no coincidence that there's such a huge gap when it comes to elections between the rural population and people in urban areas. It's the same in the UK, but also in the US. In urban areas, people tend to vote for the status quo, which would have meant Hillary Clinton, or in the UK against the Brexit, while people on the countryside who are actually suffering, who do not profit from this monetary inflation enough, they are voting against the status quo, so for Donald Trump and for the Brexit. And this is something that we're seeing all over the world. We're writing about many different other aspects and collateral damages of zero and low interest rate policies. We're focusing way too much on short-term profits. We're focusing way too much on consumption. There's some sort of a consumption burnout. We are creating zombie banks. The independence and fragility of financial markets is increasing. It has consequences for entrepreneurs, because everybody is misled by the falsified interest rate signals. So this is really something that is very, very important for us, and this is why we're dedicating so much thought and work on this topic.
It's really quite dangerous. So, for example, this podcast, we have listeners from all around the world. We have, our audience is about half US and then half many other countries. And these things obviously are global in effect. And what you mentioned about it makes the markets more fragile is a really interesting comment, because you know Jim Rickers, he's a colleague of ours, and he's also a colleague of yours, and he talks a great deal about complex systems and the idea that the whole sort of financial system is a complex system, that it's in a high energy state right now, that could see some sort of a phase transition into emerging properties or adaptive properties, right? We're in a situation right now where central banks are still doing these sort of extraordinary things and are a long way from normalization. And because of that, it makes one wonder, how long can this go on with the central banks? And, obviously, as you've pointed out, if they keep doing it, what is the effect on the fragility of the market?
Well, yeah. I don't know where to start. I mean, Jim Rickards is bringing up so many great pictures and analogies, and we all know this snowflake analogy. We don't know actually which snowflake is gonna start the avalanche, which one will cause the avalanche to come down. But sooner or later it will happen, and I think one of our calls at the moment is, and this is a highly contrarian call. We think that that a recession actually is pretty much around the corner. When I was in the US a couple of months ago, I said I'm 100% sure that Donald Trump will win the elections, because it doesn't feel like in a recession in the US. It rather feels like in a depression. And I think the both of us were pretty critical when it comes to lots of statistics, especially employment numbers, and also GDP, which is, from my point of view, it's pretty much a useless number, because it doesn't say anything about the quality of an economy. If I crash my car 5 times a week, it actually increases GDP, but do we create any prosperity, any wealth? Does our economy get better by that? I don't think so. So from my point of view, I think that the US will enter a recession sooner or later, probably in 2017 already. We've got quite a lot of indicators suggesting that. Of course, that's a contrarian call, because everybody is so upbeat now with stocks trading at new all-time highs and Donald Trump coming in. But I think that we have before every recession we basically saw rising inflation rates, we saw rising interest rates, we saw extremely high optimism. Everything was priced to perfection. So I think where there will be some disappointments coming in, and of course the strength in the dollar might cause a recession, because that's what we call the core periphery disease. The Fed policy affects especially emerging markets, and therefore the strength in the dollar will come back as a boomerang. And probably the weakest link, like always, are emerging markets, like Brazil, like Turkey, which is a big mess at the moment. The whole euro crisis is coming up again. Just follow the developments in Greece at the moment. So I think that a recession might be in the cards. And don't get me wrong, a recession is something totally normal, something really positive and healthy for our long-term prosperity. It's like having a hangover after drinking too much. It's just something normal, something that you have to live with. But if you start drinking beer again as soon as you're waking up with a hangover, I think you don't solve any problems. You're just kicking the can further down the road, the beer can. So from my point of view, really trying to avoid the recession that will come anyways with cheap money and fiscal stimulus. This will make the next recession even worse. And I think when it comes to inflation, I think this is really going to be a big topic going forward, and I'm sure we're going to discuss it within this interview.
You mentioned that the idea of sort of trying to treat the symptoms of the situation will only make it worse going forward. You know what this reminds me of is that typically government solutions, central bank solutions to these kinds of things, I totally agree. just tend to make things worse. In the United States, for a long time, just as an example, there was a policy amongst the government agency that managed the U.S. forests. And the policy was they wanted no forest fires. They wanted to prevent forest fires from happening at all. And they did this for a very long time, and the result of it is that this huge amount of unburnt underbrush kept building up in these forests. And when they finally did catch fire, the forest fires were absolutely horrible, and they were incredible in their ferocity. And it just goes to show you that the natural cycle, just like you said, if there's a recession every 8 or so years, many people know this is the business cycle. That's completely normal, and it's a natural effect, because if that underbrush got burnt off as a natural effect instead of having people trying to control it, then the amount of brush that built up would be nowhere near as much, and the fires would be nowhere near as big. And it's pretty much exactly the same thing. You see sort of natural systems in place, and this idea of, the command management of the economy. It just doesn't work. You've mentioned a couple of times now the Austrian School of Economics. Now, people who follow the concepts of honest money, sooner or later, they run across this school of economic thought. We could probably spend hours and hours talking about this, but sort of in a summary, could you explain for those of our listeners who are not familiar with it, what are the basic principles we're talking about here?
In 2 words, common sense. I think the Austrian School of Economics is the common sense school of economics. We could also call it the no free lunch school of economics.
I like that one, yeah.
And Alex, I'm not only from Austria, where actually the Austrian School of Economics is not taught at all on universities or in schools, unfortunately, and this is why we're trying to educate people about our history and our great economists like Menger, like Hayek, like Ludwig von Mises, and so on. And we should actually be really proud on those economists, because first of all, if you really want to learn more about the Austrian school, there's so much material nowadays on the internet. It's just great. We wrote a book. It's called Austrian School for Investors. Austrian investing between inflation and deflation, where we basically focus on the consequences and the advantages of knowing more about the Austrian school for investors. So we're explaining this illusion of prosperity, this illusion of paper prosperity that we're having. We're explaining why the Austrian school is very, very critical when it comes to forecasting and prophecies. Basically says that it's impossible to forecast the future because our economy is so complex. And one big differentiation that one can make is I would say that Keynesians and monetarists, they're working top down. So for them, they try to calculate big aggregates like GDP and so on. While the Austrian school starts at the individual and wants to understand the actions, the human action, like Mises said, because we're not always acting very rational. And understanding that is really important. Then, of course, there's subjectivism, there's marginalism, individualism, realism. For the Austrian school, for example, there's no objective value, because what's a glass of water worth? It depends. I mean, for me, it's now probably a few cents. But if I'm walking through the desert for 3 days, I'm gonna give everything for a glass of water. But we are seeing decreasing marginal utility of water, for example. So the second glass of water will be worth less, and the 10th glass of water will be worth much less. So we're having those effects basically everywhere. Also when it comes to debt, debt injections made sense under Ronald Reagan when our total debt level was much lower. But nowadays, with 20 trillion of debt in the US, 1 trillion of new debt doesn't really change a lot. So this marginal utility is really important. And when it comes to the big picture, I would say that the understanding of inflation is really crucial, because the Austrian school says money basically isn't much more than a medium of exchange, and if you increase the number of that, it's pretty obvious that the purchasing power will fall. So from the Austrian School of Economics, there's monetary inflation, asset price inflation, and then there's price inflation, as we said before. And this is crucial to understand. If people say there's no inflation, I say that's nonsense. There's massive asset price inflation. There's massive monetary inflation. And sooner or later, velocity, or the demand to hold money, will pick up significantly, and of course we will see very high inflation, and I cannot rule out that we're gonna see hyperinflation.
You've been listening to part 1 of the latest podcast from Global Perspectives with Alex Stanczyk, presented by Physical Gold Fund.